This Kiwi grew up poor, bought his first property at 19 and today owns over 43 houses. He's spent the better part of 2 decades as a financial advisor and seen every property mistake in the book. But today I'm not going to ask Andrew the questions he always gets asked. Instead, we're going to start with the question that most advisors won't answer honestly, so that by the end you'll have 23 years of property advice in just 17 minutes. Now, Andrew has been investing in property longer than most people. He bought his first place at 19 years old. Now he's got 43 houses and he's spent 23 years in the game, both as a property investor and a financial advisor. So today I want to really ask him the questions that he doesn't usually get asked.
So I don't know these questions yet either.
No, because otherwise I know you'd come up with some smooth answer, right?
I'm curious about the one I don't follow myself, but go on.
So one question I've got for you is, has your wealth come from being smart, or is it just because you bought at the right time when house prices were going mental?
Honestly, I know what you're doing here. You're getting me to admit that I'm a dum-dum. No, there's no way that my intelligence equals my wealth, and you know it. I know it. We all know it. I've been just smart enough to do it and dumb enough to not overthink things, and so that's what's made me wealthy, probably.
So what do you mean by that?
So what I mean by that is I know that a lot of intelligent people will talk themselves out of a deal time in and time out. So that's why your engineers, some of the smartest professionals out there, will overanalyze a deal where I will, you know what I do? I get a napkin at a restaurant, I draw up a bit of a plan, and then I do a deal or I don't do a deal. So I'm smart enough to know, okay, well, these are the numbers that matter to me, but I'm not so smart that I overthink it and then get in the way of me actually taking action. And then I just surround myself with smart people, and you.
So what do you have to say to people who would say, well, doesn't that just mean that your money's come from luck?
No, because the more you actually invest, the wealthier you get. Now, luck means that you didn't take action to get the outcome.
Okay, so let's say that you are looking to buy a property. You just said that you grab a napkin at a restaurant. I've seen it myself. You grab a pen, you start doing it. What are you personally looking for when you're buying a property?
So I know we're going to talk about one that I looked at recently in Timaru. So that was a slightly more complex based, but I think we're covering that in another episode. But I'd look at the purchase price. I'd look at how much cash I've got to put in. I'd look at, in that case, at a renovation cost. I'd look at the income that's going to come in, maybe the kind of cost that might be things that I hadn't considered. That was going to be a potential Airbnb. So there are a whole lot more considerations. And really, the main thing I want to know is what's my cash in, what's my money out? And that kind of tells me, yeah, that's a good deal or it's not a good deal.
But you're not going to sell that property, right? So when you're saying cash in, cash out, I mean, cash in's pretty easy to understand. We're talking about the cash deposit you're putting into the property. What do you count as cash out?
So cash out in that case was going to be cash flow. Now, I don't normally buy for cash flow. I buy for capital growth. So cash flow is less important to me right now. But in that case, it was a cash flow investment. So I was wanting to know how much revenue would I get per year after all my costs based on the money I put in. And then what I'm weighing up is, well, what else could I do with that money?
Well, what if it was something that you were going to hold on to for capital growth? How would you do the cash in, cash out?
So then I'm looking at, okay, well, in 15 years, 20 years time, when I sell that property, what will it be worth?
Okay. Now, we've said a few times on the show, 43 properties or 43 houses. What does the cash flow look day to day in terms of managing these 43 properties?
I'm not very good at that, if that's what your criticism is. So
there's no criticism, Andrew. The people just want to know.
So the answer would be that my portfolio probably, if I took a guess, cost me about, I would say, 50 grand a year. In terms of cash flow, negative cash flow. Now,
it's about $1,000 a week.
Yeah, about $1,000 a week. Now, I know it must be costing me a little bit more at the moment because just in the last 2 weeks, I had an alert from bank, oh, you need to top up that account. You need to top up that account. So there must be something not quite balancing out at the moment. And I haven't done a kind of a reconfiguration in the last wee while, and I've settled a few properties. So I probably need to tweak it a little bit at the moment. But about $1,000 a week I allocate right now towards my rentals.
And so what's that? The money comes in from your salary and then you're like putting that into an investment account?
Yeah.
Okay. So, but some of those 43 properties will be cash flow negative. Some of them are cash flow positive,
Yes.
and and they're kind of balancing each other out to some degree.
Yeah, to some degree. So anything cash flow positive sits within that entity. That money doesn't come back out. So depending on the group of properties it belongs to, if there say there are 5 properties in an entity, 3 of them make a profit, 2 of them make a loss. If there's still a profit left over, that money sits there for when interest rates change. If the group makes a loss, then that's being topped up by me. And again, any surplus that comes later on as rates come down, that just builds up in the account.
Okay, and so we're talking about entities here, so trusts and companies. Of those 43 properties, how many entities do you have? How many trust companies, would you say you're owning those?
7 would be my best guess.
7, okay.
No,
so
6 or 7.
Okay, so we're talking about 6 or 7 property on average,
Yes.
6 or 7 properties per entity, though some will have more than
Yeah.
others. How did you decide to be buying in all of those? There's a property, I like that one. I'm going to put that in this trust as opposed to in this company.
So part of that's just been different stages of my investment journey. So when I'm buying old properties and renovating them, when I've been buying new builds, when I've been doing them with different partners and deals. There's still one left over, which is an old property that has no debt on it at the moment. That potentially that should have some more in it. So it's really just been an evolution in time. There's not really been a rhyme or reason around that.
Okay. That's good to know. Now, what is a piece of property advice that you give to everyday people, right? Because you're a financial advisor doing this, that you don't follow yourself?
Buy only what you need to get you where you want to be.
Okay, talk to us more about that.
So what I think is my strategy has been just to build my wealth, and there's probably no need for me to keep investing other than I don't want lazy money. So, for example, that property that's got no debt on it at the moment, I'm thinking, well, actually, that's pretty dumb. I should be buying more properties in that entity so that I can use the income to fund other properties. Now, do I need to do that to get to my retirement goal or my wealth goal? No. But should I do that to have more effective return? Yeah. Now, I don't think that's right for everyone because lots of people will be sitting on a whole lot of equity in their own house and they might have some good amount in KiwiSaver, some good amount in savings or shares. They might only have to buy 1 or 2 properties to bridge the gap between where they want to be and where they are now, where they're heading. Now, they might be able to buy 10, but my advice will be, well, buy the 2 that you need, not 10. Now, for a lot of people, they might think, well, but Andrew just keeps going and doing that. Yeah, but that's higher risk. That's more risk than potentially you need to take on, and it could come unraveled for you.
So let me ask you this. When I'm going to admit something to you. I don't think I've told you, at least not on the show before, which is when I first met you, I was a timid wee lad. And didn't have a huge risk appetite. And I thought, this isn't the only reason, right? Like, I quite like you. That's why we're friends. But I thought, if I become friends with Andrew, maybe I can become more risk seeking, because they always say, well, you're the average of your 5 friends you spend time with. So I thought, well, if I spend more time with people who are risk seeking, then maybe I will have a higher appetite for risk. So where did you get it from, though? Like, where did you get your willingness to take risk from? And is it something you've had to learn, or was it something you just came out of the womb with?
I think that it's just come out of a need. So rather than me being more prepared to take risks, I think that there's a certain element of that's just in my nature, but more that I knew that without taking more risk, I wasn't going to get to where I wanted to be.
Okay. Did you ever struggle with it, or this has just been?
There's been. I tell you what I've struggled with when there was my first downturn in the market, and I was faced with the level of debt that I had. That was a real struggle, and I thought, well, have I taken on too much risk? Now, coming out the other side of that, I would say that this downturn in the market that we've just been through, I was far more relaxed than previously. Not because I was more financially equipped, which I was, but because I'm just like, yeah, we've been here before. We'll get through it. It'll be fine.
Well, this is an interesting point, because often what I see is people love risk takers. Oh, they take such great risks. And when those risks pay off and you make a lot of money, oh, yeah, that person took a lot of risk. When it goes the other way, it's quite difficult to, when you take a risk and it doesn't work out, to then be like, oh, well, this is the risk that I took. How have you managed that?
I do think that's just a time thing, because you do become less risk taking the older you get, and like now that I've got a family, and I feel more responsible to other people, like staff in the business, I am more cautious and considered with the risks I take. Having said that, I still take on risk all day, every day.
Now, I got to ask you, what's a strategy that worked, say, from 2003 to 2018, your first 15 years of property investing, that doesn't work today?
I think being able to flip properties without major tax implications, like back in the good old days when you can buy and sell a property, so long as you didn't fall into the intention rule, you weren't taxed on the profits. Whereas nowadays, potentially you've got GST, you've got income tax. There's so much of your money that goes to the IRD when you transact a property as an investment flip, that just kind of doesn't make sense the same way. You're taking on so much risk in that process that it all pays off, but you lose 50% straight off the bat.
And then I suppose the other thing that's changed there, and we had Steve Goody on the show talking about this, is the Auckland unitary plan, which freed up so much more land for developers, which meant that flippers are now competing for the same properties as developers who can make more money and outbid you.
The other thing is, like, lending criteria has changed so drastically that I could buy a property 20 years ago and it kind of didn't matter as much if the numbers weren't perfect. Like, you buy something and you'd hold on to it and, the market would kind of just do its thing over the next 5 years. Whereas nowadays, if you make a wrong move and you buy a property that holds you back, it could be 7 years, 10 years before you're buying the next one. And if you bought a dud and it's not really going up in value over that 10 years time, then you've put a whole lot of cash flow into it for nothing.
Well, let's step back, because we know that 77% of property investors just own the one property, the one investment property, right? So let's say you've got your own home, you've got your first investment property. What moves does somebody need to take to get to 2 investment properties and then 3 investment properties?
I think LVR restrictions really hold people back if everything's with one bank and it's not structured correctly. Now, split banking's great, but you don't have to have split banking to get ahead. However, with the LVR restrictions, it might. So sometimes you want to think about your lending structure and your security structure, and maybe you need to move something away so that it frees up your equity in your house to keep repeating that process. The other big thing, so someone I met the other day said, how do I keep buying properties? And my advice to him was, you need to earn more money. You need to find other ways to increase your income. And if you can do that, then the bank will lend you more money. And if the bank will lend you more money, you can carry on investing.
Okay. Well, there's so much property advice all over New Zealand, right? Whether it's from your Uncle Lester or TikTok and Instagram and podcasts and YouTube, and we're at a lot of these places as well. What actually matters in investing, and what advice can you ignore? Because of all of that advice that's out there, there's probably only a couple of things that are really going to make the difference for people.
I think the biggest thing is there's so much pressure around the cash flow side of things. And I get it, because cash flow, that happens today. But if you get so focused on today and forget about the growth in the future, like the growth, in my experience, that's what makes someone rich. That's what gets someone ahead. Now, that might mean you have to give up a bit of cash flow today, but that has a way more meaningful impact on someone's wealth in the future if you can do it right. And I see, like, lots of these property people come out and they've got these courses, and I'm going to teach you how to get the maximum cash flow. And then I actually look at some of the deals that happen. I'm like, such nonsense. In fact,
what do you mean by that?
So I always see people that are advertising these courses and will help you get a cash flow positive property. And the cash flow positive property is, you buy an old dunger that's going to be a maintenance nightmare. You chuck 14 cabins on it. Now I've got all this money coming in. It's not worth anything to anyone, really. Like, it's maybe to another investor. But when you think about, like, yes, you're generating an income today, but it's probably, by the time you pay your mortgage and all your costs, it might be a few $100 a week, 15 grand a year. Whoa. Right? I'd rather have millions of dollars later by buying good, solid assets. And yep, that comes at a cost today from a cash flow perspective. But kind of property isn't really that complicated. And the more complicated you make it, the more restrictive your market is when you sell that property later on.
Okay. And if you could get in a time machine. Oh, wow. We're back in 2003.
Yeah. Buy Apple stocks.
Oh, here's 19-year-old Andrew. Hello, Andrew. What do you want? We want to give you some property investment advice. What are you going to tell your younger self?
I'd probably trade less. I probably wouldn't have sold as many. I probably would have held on.
Don't tell me. Tell 19-year-old Andrew.
He doesn't listen to anyone. He thinks he's a bloody expert. No, I think that some of the good properties that I had, I let go of too early. So I probably would have found ways of keeping those ones.
But if you didn't sell those properties, would that have stopped you from doing other things you did?
In some cases. So I do think selling down some was the right thing to do. But definitely, like, if I think back to the interest deductibility changes, I sold a lot of properties at that period of time because outside of Brightline, that I wasn't sure when the rules were going to change or if they were going to change around interest deductibility, and the model no longer worked on that basis. And so I made maybe a bit more of a knee-jerk reaction than I would have had I known that, a couple of years later, National would come and repeal it.
Oh, so you might have held on to some of those more.
Yeah.
Oh, that's interesting. And I suppose one of the issues is that, in an ideal world, our future selves would jump in a time machine, come back to wherever we are now, and give us that advice, with the benefit of that extra 23 years experience. But unfortunately, to the best of my knowledge, we don't have time machines yet, as much as I keep on rewatching Back to the Future to try and invent one myself. So if you want to get the benefit of somebody who does have 23 years experience or 15 years experience or 10 years experience, you might like to book a session either with Andrew or one of the financial advisors that he has trained at Opus Partners. If you want to book that free session, a portfolio planning session, we'll drop a link down in the show notes and description. So now you've got 23 years of property experience in just 17 minutes. But if you want to know exactly what I'd do if I was starting from scratch today, I break it all down step by step in the next video. Click the video on screen and watch it now.